So let's go over the chapter 22 to 24 review. So this first question says Billings Company has the following information available on for May 2019. We have a unit selling price of $400. We have unit variable costs of $280, and then we have total fixed costs of $54,000. It also tells us that we sold 600 units. So with that information, we will be able to prepare a CVP income statement, a cost volume profit income statement that shows total and per unit amounts. And then we can also find our break-even point in units and our break-even point in dollars. So let's start off with the CVP income statement. So it's going to look something like this. So it's your sales minus your variable costs will get you your contribution margin. And we take our contribution margin minus our fixed costs, and that will give you your net income. So whenever they're asking for a CVP income statement, this is the setup that they are looking for. So we have the information that was given to us up in the upper left. We have our unit selling price, our unit variable costs, our fixed costs, and our units sold. We can add in all of those into this CVP income statement right now. So we were given a selling price per unit. So we will put that into our CVP income statement. We were also given unit variable costs. That was the 280, so we put that under the per unit for variable costs. And then we also have our fixed costs of $54,000. So with that information, we can now start filling out everything else. So let's start by looking at our total sales. So we're selling each unit for $400, and we sold a total of 600 units. So 400 times 600 will get us our sales amount, which ends up being $240,000. So now we'll do the same sort of thing for our variable costs. It's $280 per unit. We multiply that by our number of units sold, and we get a variable cost amount of $168,000. So we can toss that into our CVP income statement. Now we can find our total contribution margin. So your contribution margin will be your sales minus your variable cost. So $240,000 minus $168,000 gives us a contribution margin of $72,000. Then we can take our contribution margin that we just found, subtract out our fixed amount. So $72,000 minus $54,000 gives you a net income of $18,000. So we've now filled out the total column for our CVP income statement. Now we can look over in our per unit. So our per unit, along with our ratio columns here, those are all only going to be going through the contribution margin. It's just sales, variable, and contribution margin. So there's a few different ways that we could find our contribution margin per unit. We could take our 72,000 and divide it by our number of units sold. So 72,000 divided by 600 is going to give you 120. But there's an easier way to do this with the information that we were given. So we had 400 as our selling price and 280 as our unit variable cost. Those subtracted gets you $120 because your sales minus variable is going to give you your contribution margin. Now we can look at our ratios. So for our ratios, that's talking about what percentage of sales a certain line item is. So for sales, to find its ratio, we take 240,000 and divide it by itself, because sales is 100% of sales. For variable cost, we will take our variable cost. We could take the 168 and divide it by the 240,000, or, as you see in the lower right, we can also take 280 and divide it by 400, right? Take our per unit amounts for variable cost and sales. So 280,000 divided by 400 gives you a ratio of 70%. So we'll toss that in for our variable cost ratio. And once again, for our contribution margin ratio, there's multiple ways that we can get this answer. We could go 120 divided by 400, right? Take our contribution margin per unit and divide it by our sales. Or we know that sales minus variable equals contribution margin. So 100% minus 70% gives us a contribution margin of 30%. So we've now filled out our CVP income statement for total per unit and ratio amounts. So we're going to use all of this information to find our break-even point in units and our break-even point in dollars. So our break-even point in units, that formula is your fixed costs divided by your contribution margin per unit. So we take a look over at the CVP statement that we have on the left side of the screen. Our fixed costs, those were $54,000. Our contribution margin per unit, we see that as 120. So we plug in our numbers into this formula. We get 54,000 divided by 120, which gives us a break-even point in units of 450 units. Meaning we have to sell 450 units before we can start making money, right? The break-even point is where you aren't making money, but you also aren't losing money. So now our break-even point in dollars. That's your fixed cost divided by your contribution margin ratio. So our fixed costs are still 54,000. Our contribution margin ratio is 30%, which we want to put as 0.30. And then our break-even point in dollars will be $180,000. So the fixed cost amount, that was given at the start of the problem, along with our unit selling price, our unit variable cost, and our number of units sold. So there's another way that we could find our break-even point in dollars. We could take our break-even point in units that we found of 450 units. And we know that we're selling each of those units for $400. So 450 units times 400 gives you a break-even point in dollars of $180,000. So once you find your break-even point in units, you can find it in dollars. And once you find your break-even point in dollars, you'd be able to find your break-even point in units, right? Because your break-even point is a singular point. So those two numbers are 450 units and our $180,000. they're related, they're connected, because that's a single point on this graph. So let's move on to question number 2. So question 2 says Harris Company sold 50,000 units for $20 each. The company's total costs are $800,000. So we need to compute the margin of safety in dollars and then the margin of safety ratio. So the margin of safety is how much wiggle room do you have above the break-even point, right? It's that safety net from your sales down to your break-even point. So we have some calculations we have to do first. We need to figure out how much they made in sales. So they sold 50,000 units for $20 each. So your total sales will be those two amounts multiplied together. So 50,000 times 20 gives us a total sales amount of $1 million. So we have everything that we need to start figuring out our margin of safety. So your margin of safety will be your sales minus your break-even point. Now our break-even point, remember, that's just how much we need to sell to cover all of our costs. Well, our total cost amount given to us is $800,000. So our margin of safety in dollars will be our $1 million in sales minus that $800,000, giving us a margin of safety in dollars of $200,000. So we've sold $200,000 more than our break-even point. Now for our ratio. For the ratio, we need to take our margin of safety in dollars and divide it by our sales amount. So we found our margin of safety in dollars in that last part of this problem. It's 200,000. So if we take 200,000 and divide it by our sales amount of 1 million, we're given a margin of safety ratio of 20%. So that's how we find our margin of safety in dollars and our margin of safety ratio. Now we can move on to question number 3. I would recommend taking a picture of the screen right now, because we are going to be referencing back to all of this information as we move through this problem, because we have a lot of different pieces to this problem. So let's work through it. It says Coulter Company had sales in 2018 of $6,800,000 and a gross profit of $1,100,000. Management is considering 2 alternative budget plans to increase its gross profit in 2019. So plan A, the first plan, it would increase the selling price per unit from $8 up to $8.40, but sales volume, the number of units that we'd sell, would decrease by 10% from its 2018 level. Plan B, our second alternative, would decrease the selling price down to $7.50. And the marketing department thinks that by decreasing the selling price, our sales volume would increase by 100,000 units. Then it says at the end of 2018, Coulter Company had 40,000 units of inventory on hand. If plan A is accepted, the 2019 ending inventory should be equal to 5% of 2019 sales. And if plan B is accepted, the ending inventory should be equal to 60,000 units. Each unit produced will cost $1.80 in direct labor, $1.40 in direct materials, and $1.20 in variable overhead. The fixed overhead for 2019 should be $1,895,000, and that will be for both Plan A and Plan B. So we need to prepare a sales budget, a production budget, figure out our production cost per unit, and then decide which plan should we go with, Plan A or Plan B. So those are going to be the 4 parts to this question. So first, let's look at a sales budget. So a sales budget just has a few lines to it. Has your expected unit sales, so how many units are you thinking that you'll be able to sell, a unit selling price, and then those two multiplied together will give you your total sales. So under Plan A, they said that the selling price would increase to $8.40. So we can put that as our Plan A unit selling price. Under Plan B, said that the selling price would drop to $7.50. So now let's just look at Plan A. And we need to try and figure out how many units do we think we're going to sell. Well, they told us that sales volume would decrease by 10%. But they didn't come out and specifically tell us what our sales volume was for the previous year. We have to go through and calculate that. So our 2018 sales volume will be our 2018 sales amount divided by the 2018 selling price. So in 2018, they had sales of $6,800,000. And they sold each unit for $8. So we divide those and we see that the sales volume in 2018 was $850,000. So here under Plan A in 2019, we're saying that sales volume will decrease by 10%. So we need to figure out what our 2019 sales volume will be. And if it decreases by 10%, that's the same thing as saying that the 2019 sales volume will be 90% of 2018's. So we find 90% of 850,000, and we get our sales volume for 2019 under Plan A as 765,000 units. Meaning, if we go with Plan A, we expect to sell 765,000 units at a unit selling price of $8.40. To find our total sales, we multiply those two numbers together. So Plan A, we expect would lead to total sales of $6,426,000. Now we can take a look at Plan B. So we were told that sales volume will increase by 100,000. Well, we already found that 2018's sales volume was 850,000. So if we think it's going to increase by another 100,000, 2019 sales volume will end up being 950,000 units. So we toss that into our sales budget. So we have expected units, unit selling price, and we can find our total sales by multiplying those two together. So 950,000 times $7.50 gets us a total sales amount of $7,125,000. So our sales budget all put together would look like this. So this is done at the start of the year, going into the year, saying, okay, if we go with plan A, this is what we think is going to happen. If we go with plan B, this is what we think is going to happen. So right now, plan B looks better, right? There's more in sales happening under plan B. So we'll keep that in mind, because our last step to this problem is figuring out which plan should we accept. So after preparing a sales budget, we then needed to prepare a production budget. So our production budget, if we just look at the words over on the left, it's your expected unit sales, and then you add in your desired ending finished goods. That will give you your total required units. You subtract out your beginning finished goods, and that leaves you with your required production units. So how many units do you need to make in this year under each plan? So we already have our expected unit sales for each plan. We found that back on our sales budget. Now we need our desired ending finished goods. Or let's start with our beginning finished goods. So our beginning finished goods were given to us, right? So it says at the end of 2018, Coulter Company has 40,000 units of inventory on hand. And so if that's what they ended 2018 with, that's what they're going to be starting 2019 with. So we can toss that into our beginning finished goods. Now we can work on finding our desired ending finished goods. Let's start with just plan A right now. So we're told for plan A, the 2019 ending inventory should be equal to 5% of 2019 sales. So our 2019 sales were 765,000 units. We multiply that by 5%, or 0.05, and we have a desired ending finished goods of 38,250 units. So we can put that into our production budget. Our total required units will be your expected unit sales, adding in your desired ending finished goods, which gives us 803,250 units. Then we can subtract out our beginning finished goods, and we end up with a required production units of 763,250. So under plan A, they would have to produce 763,000 units that year. Now let's take a look at plan B. So plan B's desired ending finished goods, they told us in the problem it should equal 60,000 units. So this one's much easier than plan A. So we just toss in the 60,000. We get a total required units of 1,010,000. And when we subtract out our beginning finished goods, we end up with required production units of 970,000. So under this plan B second alternative that we have, we would have to produce 970,000 units. So your production budget altogether would look like this. So now our next step is to compute the production cost per unit under each plan. So we're going to set something up like this, where we have our total variable, our total fixed, we add those together to get our total costs. Then we have our total units that we had to produce based off of our production budget that we just made. And using the total cost and the total unit amounts, we can find our unit cost. So you'll notice under plan A or plan B, your total fixed is the same amount, right? That's not going to change. The variable is going to change because our total units change. But let's talk about our variable cost right now. We were told that each unit will have direct labor, direct materials, and variable overhead. $1.80 for direct labor, $1.40 for direct materials, and $1.20 for variable overhead. So each unit is going to have variable costs of $4.40. That remains the same for plan A or plan B. However, for plan A, they're producing 763,000 units. So we take our $4.40 multiplied by our units for plan A, and we get a total variable of $3,358,300. So we can put that into our plan A column. So now our total cost, that's just your variable and your fixed added together. So under plan A, the total cost was going to be $5,253,300. So then we need to calculate our unit cost. So that's going to be your total cost divided by your total unit. So 5,253,300 divided by 763,250, and we get a unit cost of $6.88. So under plan A, each unit produced will cost $6.88. Now, if we look at plan B, we said that that variable cost per unit was still going to be $4.40. However, we're now producing 970,000 units. So we take $4.40, multiply it by 970,000, and we get a total variable cost amount of $4,268,000. So now that we have our total variable and our total fixed, we can now find our total cost amount under plan B by adding together our variable and fixed, and we end up with total cost of $6,163,000. Now we need to calculate our unit cost again. So we have our total cost, and we have our total units. If we take our total cost divided by our total number of units, we will end up with a unit cost under plan B of $6.35 per unit. So we can compare these two plans right here. The total cost amount under plan A is lower, but the unit cost under plan A is higher, right? Just because there's such a difference in our total number of units. That's what's making this difference happen between the total cost and the unit cost. So now the important part, right? So managerial accounting is all about making these decisions. You've made a sales budget, a production budget, you found out your cost per unit. None of that matters if we can't make this decision here. So which plan should be accepted? Well, we are going to choose the plan that has the highest gross profit for our company. So to find gross profit, we take our sales and we subtract our cost of goods sold. So we have our sales amounts from our sales budget, right? Plan A, we found that our sales were going to be 6.4 million, and Plan B was going to be 7.1 million. And after that point, if you remember, we talked about how Plan B looked better, right? Because Plan B was going to get us more in sales. So, cost of goods sold, what we need to do is we need to take our number of units sold multiplied by our unit cost. So, 765 times $6.88 and 950,000 times $6.35. So we find our two cost of goods sold amounts for Plan A and Plan B. So we toss that up into our gross profit calculation. So again, your sales minus your cost of goods sold gets you your gross profit. So we'll see that Plan A has a gross profit of $1,162,800, and Plan B has a gross profit of $1,092,500. So which plan should we accept? Well, we want the higher gross profit. That's the higher of the gross profits, so we are going to choose Plan A. So that's why we couldn't have just made that decision after the sales budget, because there's more that goes into it than just how much in sales a company makes. Now let's talk about question number 4. So we will eventually have to be preparing a direct materials budget for the month of January. We have all of this information given to us. Page Corporation has 2,000 pounds of raw materials in its December 31st, 2018 ending inventory. Required production for January and February of 2019 are 4,000 and 5,000 units respectively. 2 pounds of raw materials are needed for each unit, and the estimated cost per pound is $6. Management desires an ending inventory equal to 25% of next month's materials requirements. So a direct materials budget, it's going to look like this. So we were given all of that information on the last slide. So now we just need to start filling out this direct materials budget. First piece, our units to be produced are 4,000, because we were told that the required production for January was 4,000 units. So that's where we get that 4,000 for our units to be produced. Now, direct materials per unit. Well, we're told that there's 2 pounds of raw materials needed for each unit. So, it's 2, because there's 2 pounds of materials going into each of these units. So our next line here is the total pounds required for production. Well, if we are producing 4,000 units, and each unit requires 2 pounds of materials, we multiply those together and find that we need 8,000 pounds of materials for production. Now, we need to figure out our desired ending inventory. It tells us that management wants an ending inventory of 25% of next month's materials requirements. Well, next month's materials requirements, that's the 5,000 units that are being made in February times the 2 pounds per unit. So next month's requirements are 10,000. So we want a desired ending inventory of 25% of that. So 10,000 times 0.25 gives us a desired ending inventory of 2,500. So we can toss that into our desired ending inventory in our direct materials budget. So our total materials required is going to be your total pounds required for materials, or required for production, that 8,000, and we add in our desired ending inventory. So 8,000 plus 2,500 gives us total materials required of 10,500. Now, we need to subtract out our beginning materials inventory. Well, our beginning materials inventory, we're going to have to think a little critically here. Management wants an ending inventory equal to 25% of next month's materials requirements, right? So January's beginning inventory is December's ending inventory. So we need to be thinking of what was December supposed to end with? Well, if you're in December, next month is January, right? So next month's requirements were those 8,000 pounds that we found already in our budget. So the desired ending for December was 2,000. So if that's what December ended with, that's also going to be what January begins with. So we can put that 2,000 into our beginning materials inventory. And when we take our total materials required minus what we started with at the beginning of the month, it's going to tell us that we need to purchase $8,500 worth of materials. Now, each of these pounds of materials told us the estimated cost per pound was $6. So if we need to purchase 8,500 pounds and each pound is $6, the total cost of direct materials purchases are those two multiplied together, which is $51,000. So you can expect in January to spend $51,000 on direct materials purchases. So that's a direct materials budget. Question 5 is going to want a direct labor budget. So it says for Thomas Company, units to be produced are 5,000 in quarter 1 and 7,000 in quarter 2. It takes 1.6 hours to make a finished unit, and the expected hourly wage rate is $15 per hour. So we need to prepare a direct labor budget for each of the quarters for the first 6 months ending June 30th, 2019. So we have our information up in the top left, and then we have our direct labor budget. So our direct labor budget, we have quarter 1, quarter 2, and then for the full 6 months. We need units to be produced, direct labor time per unit. Those two together will help us find our total required direct labor hours. And then we have our direct labor cost per hour, which will help us find our total direct labor cost. So first, units to be produced. Well, it tells us up in the problem that in quarter 1, we're producing 5,000 units, and in quarter 2, we're producing 7,000. Then, our direct labor time per unit tells us that it's going to take 1.6 hours to make a finished unit. So, if we multiply those together, we see that in quarter 1, we're going to need 8,000 direct labor hours. If we want to make 5,000 units and each unit's going to take 1.6 hours, that's 8,000 total hours. In quarter 2, we want to make 7,000 units. Each of those units will take 1.6 hours, so it will require a total of 11,200 hours. Now our direct labor cost per hour. Well, it tells us up in the problem that the expected hourly wage is $15 per hour. So we'll put our 15. Then to find our total direct labor cost, we multiply the 15 times our required direct labor hours. So for quarter 1, that's 8,000 times 15, and quarter 2, 11,200 times 15. And we get our total direct labor cost for each individual quarter. So in quarter 1, direct labor, we're expecting it to cost $120,000. In quarter 2, it'll be a little bit more. We think it'll cost $168,000. Now you'll notice we haven't done anything over in the 6th month column quite yet, right? That's only there for this total. Your total direct labor cost for the first 6 months of the year, where you take your 120,000, you add your 168. So we don't go through our units to be produced, direct labor time, none of that for the 6th month column. It's just your total direct labor cost. Now, our last question here. We have some information from Batista Company. We have a sales amount, we have variable cost, controllable fixed costs, and average operating assets. Then it tells us management is unhappy with the investment center's return on investment. It's asking the manager of Division A to submit plans to improve ROI in the next year. The manager believes it's feasible to consider the following independent courses of action. So we need to figure out which of these courses of action should we implement, right? So should we increase sales by 300,000 with no change in the contribution margin? Is reducing variable costs by 150,000, is that better? Or reduce average operating assets by 4%. So we need to compute the ROI for the current year, the information up there in that table right now, and then using the ROI formula, find the ROI under each of the proposed courses of action. So we have our ROI formula. That's your controllable margin divided by your average operating assets. Now make sure that you are using your controllable margin and not your contribution margin. So your controllable margin, you can see how we can find that over on the left right now. You take your sales of 3 million. You subtract out your variable cost, and that gets you your contribution margin. Now your contribution margin minus your controllable fixed costs, which we were given as 600,000, that will give us our controllable margin. So we can plug in those numbers into our ROI formula. Our controllable margin is 450,000. Our average operating assets are 5 million. So the ROI for the current year is 9%. So we will keep that in mind as we go through each of our 3 independent courses of action to see, are they better than the current year and are they the best option? So this first independent course of action said increase sales by $300,000 with no change in the contribution margin percentage. So there's some work that we need to do before we can just start plugging numbers into our ROI formula. We have our original information down in the lower left. So we need to figure out the contribution margin percentage that we had originally, because we're told that that's not going to change. So we need to make sure that that's not going to change. So our sales, again, that's 100% of sales. Variable cost, we take that 1,950,000 divided by our sales amount of 3 million, and we see that our variable costs are 65% of sales. Contribution margin, we can take 1,050,000 divided by sales, or we can also just do 100 minus 65, which will give us a contribution margin percentage of 35%. Now we can figure out what our new numbers will be with this increase in sales. So sales are increasing by 300,000. So they are now going to be 3,300,000. Variable costs are going to be 65% of sales. So we take our 3,300,000 times 0.65 and you get 2,145,000. Then if we take our sales times 0.35, our 35% contribution margin ratio, we get $1,155,000. We could also have found our contribution margin by taking our sales and subtracting our variable costs. Now, this alternative doesn't mention anything about controllable fixed costs, right? So that's still going to be 600,000. So if we take our contribution margin now, our new contribution margin, and we subtract out the controllable fixed costs that we have, our controllable margin is now $555,000. Now we have the information that we need to find our ROI. Our controllable margin is $555,000, and our average operating assets, that's still that 5 million that we had at the start. So now the ROI for this alternative is 11.1%. So the good news is that we've found an alternative right off the bat that's better than the original amount. The original ROI, if you recall, was 9%. So we want an ROI to be as high as we possibly can get it, right? So this is higher than our original ROI, but it still might not be the best alternative. So we need to check out the other two to see if those get better ROIs. The second alternative for us is to reduce your variable costs by $150,000. Well, we have our original information again over in the bottom left, and our new information in the bottom right. The only change that's happening is reducing your variable costs. So your sales, that remains at the 3 million. Your variable, this is what's going to change. It was 1,950,000. It's reducing by 150. So we get a new variable cost amount of 1,800,000. So our contribution margin is the difference between those two numbers, which is 1,200,000. Our controllable fixed costs are still 600,000, giving us a controllable margin of 600,000. So now we plug in the numbers that we know into our ROI formula. So our controllable margin is 600,000, and the average operating assets is still 5 million. So 600,000 divided by 5 million gives you an ROI of 12%. So this one's not only better than the original, but it's also better than the first alternative. So we'll keep that in mind as we keep going in this problem. Our last alternative is reducing our average operating assets by 4%. So we have our original information in the lower left. Then we have what this alternative is going to be changing. Our average operating assets going into this were 5 million. 4% of 5 million is 200,000. So we need to decrease our average operating assets by 200,000. So 5 million minus 200,000 equals 4,800,000. That's your new average operating assets amount. So we plug in our information into the ROI. Our controllable margin, that's our 450,000 that we had from the original problem. Because this change in your average operating assets did not affect that controllable margin. So we take the 450,000 and we divide it by our new average operating assets that we just calculated. And when we do that, we get an ROI of 9.375%. So it's still better than the original, but it's worse than the other two alternatives. So which alternative is best? The original ROI was 9%. Alternative 1, which was increasing our sales with no change in the contribution margin, that ROI was 11.1%. Alternative 2, reducing variable costs, that gave us an ROI of 12%. And alternative 3, reducing your average operating assets, gave an ROI of 9.375%. So again, you can see each alternative is still going to be better than the original situation that the company was in. But there's a clear-cut winner as to which alternative we should choose. And that's number 2, because that has the highest ROI among the 3 alternatives.